When it comes to building wealth in the stock market, there's an age old debate: dividend investing versus growth investing. One promises steady income and compounding cash flow. Think Coca Cola or AbbVie, while the other bets on innovation and price appreciation like Nvidia or Palantir. Both strategies have created millionaires, but which one is better for the long term? Today, I'm going to break down both sides so you can decide which one is a better fit for your portfolio, your goals, and your timeline. And if you stick around to the end, I'm going to reveal what my top three dividend investing and growth investing stocks or ETFs are. So that should give you a couple of ideas of what you can potentially add to your portfolio. But before we get started, welcome back to the channel where we discussed how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the market. What we discuss here may work for my portfolio, but it might not work for yours. So let's get started. Let's start with the simple idea. Wealth in the market is built through either income investing or growth investing. Dividend investors prefer to get paid while they hold on to shares. They like receiving that quarterly or monthly income, like clockwork, whether it's for retirement, disposable income, or just for paying bills. Growth investors prefer letting their capital appreciate inside of a company until it's worth much, much more later on, and then cashing out for a huge windfall of profit. Neither side is wrong, they just approach success differently. So let's take an objective look at both sides of the coin. Dividend investing is about buying shares in a company that shares profits directly with the shareholders, typically every quarter. Think Procter and Gamble, Johnson and Johnson, all the big companies. There's also the option of buying dividend ETFs like SCHD, DGRO, or VYM, or high yield monthly income ETFs like SPYI, QQQI, JEPI, JEPQ, and so many more. For investors that actually want to invest in real companies because they like the security and safety of the big names, there's also the list of dividend kings and dividend aristocrats. Businesses and real companies that have been paying and increasing dividends for decades. These are stable, cash generating companies that reward investors not just with price appreciation, but consistent dividend income. For an example, Altria Group, ticker symbol MO, is a stock that I've held for many years. It's a dividend king that sits with a dividend yield over 6% and has consistently increased its dividend for the past 56 years. That's the definition of reliability. Here's a list of some of the top rated dividend kings available to purchase and pad your wallet over time. So you're probably wondering, what's the main appeal? Essentially, it's passive income and compounding shares and dividends over time for consistent passive income, and one day that huge snowball effect, which is what happens when you drip and consistently reinvest your dividends, which in turn buy more shares, accelerating your growth over time. Truth be told, it does sound pretty amazing to basically buy shares of companies and sit back and just collect paychecks every quarter or every month. Not only earning price appreciation, but also getting juicy dividends that help pay for basically living your life. Passive dividend income can easily replace your current employment income and cover many expenses without actually having to sell any of your shares. Dividends are typically dependable regardless of if the price of the stock goes up or down. However, there's definitely a flip side to that coin. Companies can raise dividends, but they can also reduce the dividend yield or just cut them out all completely. What was once a nice monthly or quarterly dividend check that you were getting is now completely gone. And now you're left with a stock that to you is probably worth nothing because the only reason you had it was because of the dividend income. That's definitely something that you need to keep an eye on. A big reason why long-term dividend income investors prefer the slow and steady approach of investing in companies that are usually on the dividend kings or aristocrats list. Another thing to think about is that this snowball effect where you're just going to be raking in the big bucks doesn't happen overnight. Doesn't happen in a month, 6 months, a year, 2 years. It just really depends on how much you've invested into the market because it takes time to earn substantial dividend income. Realistically, it can take decades, and some people just don't want to sit around and wait that long. Because of this leads to people basically gambling on high yield dividend ETFs. Think YieldMax. They pay massive dividend yields, but at the end of the day, you're basically sacrificing the NAV for steady income at this current time. The value of the stock price continually goes down while you still collect your dividends, but it can only last for so long. If that dividend yield goes away, your investment in that product essentially would have gone down. I don't recommend personally investing in yield max stocks or anything that has NAV erosion, but ultimately at the end of the day, you have to decide what's best for you and your account. Investing in dividend kings and aristocrats are the best way to build long-term steady income, and the longer you can hold and buy these stocks and let them reinvest, the more chances of a bigger payday you're going to have. It's just a matter of being patient and allowing it to happen. Now, for growth investors, they take a completely different path. Instead of paying dividends to their shareholders, growth companies reinvest their profits back into the company. Think expansion, R&D, entering new markets, buying competitors or support chain companies, and capturing market share. Think companies like Amazon, Meta, Nvidia. And yes, I know Meta and Nvidia both pay dividends, but they're fairly new and their percentage, their dividend yield is so incredibly low, it really doesn't even count. I think Nvidia's dividend yield is at 0.02%, so I think you make a penny for every share that you own. These dividend yields are definitely not going to buy you a Lambo, so I don't even consider it. But these are just some names that reward their shareholders through massive price appreciation and not dividend income. The philosophy is pretty simple. Let the company profits compound internally so that your returns come through price appreciation and not the payouts. Over the past decade, growth-focused ETFs and indexes like QQQ, which I've talked about here on the channel before, have outperformed dividend ETFs and stocks, simply because the tech companies it holds in its index have exploded with growth over the last handful of years. These are the types of companies that everyone wants to work for and hold in their portfolio, and make up huge percentages of ETFs that have experienced massive growth over the last 10 years. Taking a look at SCHG, SPMO, QQQ on a 5-year return, SCHG returned almost 113%, Triple Q is 108%, and SPMO is just over 135%. These pay very low dividends, if any, and you're primarily buying these simply for the price appreciation. However, keep in mind that risk tolerance is very important here. Growth stocks are far more volatile. They can deliver massive gains, but they can also have massive drawdowns and pullbacks, especially during recessions, rate hikes, bad news, bad company news. There's a plethora of reasons why, so always have to make sure that your risk is in check. As an example, you can see in 2022, QQQ had a drawdown on the year of almost 33%. So the consensus here is if you can stomach the volatility for the potential maximum long-term upside, growth investing is a far more rewarding ride. Sure, you're going to definitely have massive pullbacks and drawdowns, but the upside is extremely rewarding. For an example, both of my Palantir positions have returned over 1,000% over the last couple of years. And people that have been in Nvidia since the very beginning, they've seen exponential wealth growth. As you can see here, Nvidia is over 1,200% return, and Palantir is almost 1,800%. So if you're willing to risk that volatility, you can potentially reap massive rewards. Unlike dividend stocks, growth stocks, the only way to see income and gains is to sell your shares. So one thing that both dividend investing and growth investing have in common are taxes. Dividend income can typically be taxed as regular income, even if you reinvest the shares and don't actually realize those profits in your bank account. Growth stocks, on the other hand, only trigger taxes when you actually sell and realize the gains. It's definitely something to keep in mind, as different dividend ETFs and stocks can be taxed differently. whether it's a 60-40 long-term, short-term capital gains, a return of capital, qualified dividends versus non-qualified dividends, such as a business development company like Ares Capital that is taxed as normal, non-qualified dividend income. So this is definitely something that you'll want to talk with your CPA or tax advisor about as to which way you want to invest in or which account you want to hold it in. And what I mean by that is, do you want to hold it in a taxable brokerage account so you could actually live off income or use it when you please? Or do you want to put it in a IRA or a Roth IRA retirement account? Let it compound, whether you pay taxes up front in a regular IRA or you withdraw tax-free in a Roth IRA account. I have SCHD in my Roth IRA account as well as a taxable brokerage account. So not only can I pull income out currently in my taxable brokerage account, but I can also let it compound tax-free in my Roth IRA account. So it's just something for you to think about as to how you want to hold specific growth ETFs, growth stocks, dividend income ETFs, and dividend growth stocks. I definitely recommend talking to a tax professional if that is something you're leaning towards. So now let's just compare the two approaches, dividend investing versus growth investing. I'm going to use two ETFs for this example. First, we have VIG, which is the Vanguard Dividend Appreciation ETF, which holds companies with a history of increasing dividends. And we're going to compare it to the Vanguard Growth ETF VUG, which focuses on large cap growth stocks. So as you can see in this current graph, over the last 10 years, with this bull market that we've had the privilege of being a part of, VUG delivered strong total returns thanks to growth from companies like Microsoft, Apple, Amazon. So obviously VUG, with all the tech companies that are involved, had massive gains compared to VIG. However, if we go back to the inception when these started, and you see that VIG has a consistent dividend income reinvested, the gains are monumental. VIG's appreciation is more than tripled what VUG has returned since inception, because you have a lot of years where there's been drawdowns or flat growth in the markets. This is a perfect example showing of how much dividend income reinvested can grow your portfolio. So as far as which strategy is better, it's really up to you, the holder of your account. Historically, it just depends on the time period. During high growth market cycles, growth investing dominates. Look at what's happening right now with Nvidia and Palantir. However, in sideways, uncertain markets, dividend investments often outperform because investors want stability and yield. When the market pulls back into a bear market, growth stocks decline while dividend stocks actually keep building and growing because those dividends don't stop. So if you're younger and focused more on aggressive growth, growth stocks and ETFs definitely make more sense. You've got time to weather the storms and the downturns in the market cycles, while if you're nearing retirement or prefer predictable cash flow, dividend investments can provide that consistency and long-term income while experiencing lower volatility. The truth is, for me personally, I like to combine both. Growth stocks fuel long-term expansion, while dividend payers provide balance and cash flow, especially in turbulent times when the market gets rocky. So as for my top stock and ETF picks, I have a wide range of stocks in both my taxable and retirement brokerage accounts. For dividend stocks, I have companies like JP Morgan, AbbVie, Altria Group. For high yield or dividend growth stocks, I have SCHD, SPYI, QQQI. For growth companies, I have Palantir, Nvidia, Amazon. In growth ETFs, I have QQQM, SCHG, SPMO. Those aren't recommendations, but they're definitely ones that I think are great companies or ETFs that will continue to do well in this current cycle we are in. So keep in mind, at the end of the day, it's not about choosing one strategy over the other because there's no wrong or right answer. It's about aligning your investments with your goals. If you value income and stability, dividend investing is definitely the way to go. If you want long-term price appreciation and massive growth, growth investing is perfect for you. Just remember what your risk tolerance is. Whichever path you choose, the key is to stay consistently investing into the market. Reinvest your returns and let time work for you. Whether your money grows through cash flow or capital gains, the real secret to wealth is consistency. I personally choose both strategies because I find them beneficial. Don't forget to check out the video right here about how to build long-term sustainable wealth, or check out the blog at portfoliopayday.com to learn more about dividend and income investing. Hit that like button, subscribe for more investing insights, and let me know in the comments down below. Do you lean more toward dividend investing or growth investing?